Good morning, everybody. Good to see you all. I'd like to just talk through the latest corporate overview for 1PM and our most recent results, 31st of May, year end, and we announced the results back in September. The first question usually from investors is 1PM, what does it stand for? I've told you this before, many of you, but it's derived from one payment monthly, which gives you a clue as to the kind of business we are. Fundamentally, we are a money lender. We have implemented a buy and build strategy over the last few years. I first got involved in the company in 2014 when we were one site, 13 staff and a £19 million book. This just simply depicts where we are now. So I'm pleased to say that we've grown significantly to 140 million book roughly, and just over 30 million of revenue and 8 million of operating profit. And essentially that's been done through a buy and build strategy that I've talked to you about on a number of occasions. Very briefly, who we are and what we do then. So we describe ourselves as a non-bank specialist finance provider. So we're not a bank and we have no plans to become a bank, and that's largely because our lending is focused on SMEs. We describe ourselves as customer outcome led. That's very much embedded in how we operate as a business. And we operate what we call a hybrid model. So we are both a lender on our own balance sheet where we take our own risk, and we're also a broker passing business on to other lenders. And in our particular marketplace, we think commercially that's exactly the right strategy and the right place to be. Our own balance sheet lending is all to UK SMEs who meet our credit criteria. We're very happy to deal with consumer finance inquiries and we get consumer finance proposals, but we pass those all on, we broke those all on to other lenders. And as I say, we broke on funding proposals that are outside our credit criteria. So for example, if a company comes to us for a £75,000 loan, that's outside our criteria, we would lend up to typically £35,000. So we'd broke that on to another lender for the likes of Funding Circle, for example. And I think over the years with our buy and build policy and with the key competencies that we adhere to, we've delivered a pretty robust quality and quantity of earnings, and we'll go into that in a bit more detail. So our market positioning is this. We have very deliberately set our stall out to be multi-product, all the financing products that we feel that SMEs require. So in very simple terms, asset finance, vehicle finance, loans and invoice finance. One key point to note on vehicle finance is that we don't take any residual risk in vehicle finance on our own balance sheet. So 100% of our vehicle finance opportunities we broke onto other lenders, the likes of Private and Commercial Finance Bank, Motor Novo and others. So the business is divided into four operating divisions, and the numbers that you see in these boxes here give a flavour of the four operating divisions and how the figures break down in each one. So these are the numbers through to 31st of May 2019. So as you can see, our total origination splits down roughly 54 million with asset finance, similar figure for vehicle finance, 35 million for loans, and then 17 million for invoice finance. And you can see that the book figures are skewed towards asset finance. So our largest part of our book is 87 million for asset finance. As I mentioned, we broke all business on for vehicles, so there's no lending book as such in the vehicles division. Our loans division is the smallest part of our portfolio, and that's deliberate. We think there's more competition and clearly more risk in loans, so that's a smaller part of our portfolio. And with invoice finance, the book is now over 40 million, about 42 million. You can see the interest rates that apply to the different businesses and the typical terms of lending. So typically we'll be doing a lease or a loan deal over 3 years. A typical invoice finance facility will be for 2 years. Our blended interest rate, that's the price that we charge our borrowers across the whole business, is about 16%, 16. And we'll come on to it later, but our blended borrowing rate is about 4.5%, 5%. So we're maintaining 11.5%, 12% margin where we can in our business. And just to sort of bring this to life, I thought I'd just run through a few deal examples. There's nothing particularly flagship or marquee about these deals. These are the kind of things we're doing on an everyday basis. So the first 3 columns there are leasing deals. And this ranges from sort of soft assets to hard assets. Soft assets are things like tables and chairs for restaurants. There's no value in those assets after a a period of use. So when we lend, it's all about the quality of the business, their business plan, their affordability to make repayments, and it's making sure we take a personal guarantee from the directors or proprietors of the business. For hard assets, things like JCB diggers, there's much more of a second-hand resale value for those. We know what those values are for that kind of kit after a period of use, so it's easier to be able to put together a sensible loan to value at the outset and structure the appropriate deal. The third one there, this happens to be Rangers Football Club, much to the disgust of my non-executive director, who's a Celtic fan. But with Rangers, they came to us for £300,000 worth of funding for their turf lighting, that low-level lighting that goes over the grass before and after a game. So 48 months, 14%, that's a good deal for us, a good yield. They came back to us for some more funding for their commercial laundry at the stadium, and we said, well, we think we're exposed enough to you, thank you very much. So we broke that deal on to Macquarie, as it happens in that case. So we're happy to broke business on to other funders and to take deals out of the market in that way. The vehicles and loans columns there are our broking business. So we broke business on for second-hand vehicles. We broke business on for property deals. So this would be, I don't know, some form of barn conversion or extension, for example. Happy to deal with the underwriting and the processing of deals like that, but then pass them on to other funders. And then the final example there, invoice finance. That's a vanilla facility. This particular company happens to be providing computer equipment for assistive learning, as it's called. A £700,000 facility over 12 months. That's the regular kind of business that we do with Generate. So those are the kind of deal examples that we do on a day-to-day basis. The three things that are important to us are spread, security, and margin. And I think that spread is important in everything we do, whether it be on the lending side of our business or on the borrowing side. So as you'll see later, we borrow from a number of funders. What we like is a high volume of small value deals. So our largest lease is £450,000, but that's unusual. The majority of leases that we do are over 3 years and typically are around £15,000. Our largest invoice finance facility is around £1 million. In fact, I think that might be slightly higher now on a couple of examples, but the average is typically £150,000. So what we like is a good spread of deals across many different sectors and lots of small ticket financing. With security, the lowest level of security that we will take is a personal guarantee, and the personal guarantee is a very effective tool at this lower level of lending. So if, for example, we're securing a £10,000 or a £15,000 deal on a personal guarantee, we know that if a deal becomes bad and becomes impaired, we can convert that personal guarantee into a charging order and recover our money that way. And the reason I say it's very effective is that if a deal does go bad and we have to go back to the guarantor, by hook or by crook, usually a guarantor can find £10,000 or £15,000 in terms of putting a payment plan in place or finding the funds to be able to meet that liability. If, however, a business has lent £100,000 against a personal guarantee, you're probably never going to see that money back because it's too much for an individual to find. And so personal guarantees work very well at that level. And we've got data going back over the last 10 years of our business showing that for 75% of deals that have become impaired, we collected the value back through the personal guarantee process. And we do that in-house. We have individuals in-house who convert personal guarantees into charging orders in order for us to be able to recover our money if a deal has gone bad. As I say, that's the lowest level of security we take. We will also take a fixed and floating charge over a company's assets or a debenture over a business's invoice finance book, for example, or indeed specific asset security against loans if we're able to do so. And then thirdly, margin is important to us, as I mentioned. We're lending at about 16%, borrowing at about 4%, so maintaining a 12% net interest margin is important as we go forward. And we would rather not chase aggressively top-line growth at the expense of credit quality or at the expense of margin. We'd rather use our hybrid model of being a lender and a broker and broke business on to other lenders if we choose to, in order to make sure that we can preserve our margin. So those are the core things that are important to us. Those are the fundamentals of the business. I think the next slide takes you through a summary of those aspects of the business that add up to a robust business as I see it. That's probably the appropriate point for me to hand over to you, Ed, if that's all right, to pick up at this point for the rest of the presentation.
Thank you. Yes, as Ian was saying, the spread and the business model being focused on security is important to us. We're not a bank. We're not operating in tier one sector of business lending or consumer lending. We're operating in owner-managed businesses, small businesses with turnovers generally from new starts up to £5 million. So understanding how to get our money back when things go wrong is really important, and having the right level of security to do that through debentures, through charges on assets, through personal guarantees, and through making sure we get the right rate for the job is important for us, and that's where we sit in the marketplace, as opposed to typical banks that will operate at the higher end of the spectrum. So spread and diversity is important, not just in terms of the size of the deal, but in terms of our introducer base. We've got lots of introducers that we get business from, lots of origination channels, which gives us a natural hedge against being restricted just to one or two categories of introducers. We're spread across the country. We don't have any particular concentration in any part of the country. It's all widely spread. And as Ian said, the deal size is quite low, average size of £15,000 or so on the asset finance side, £150,000 on the invoice finance side. Our operating model provides us with flexibility as well. So you'll see in some of the figures that we come on to, last year we actually decided to broker out more business than put on our own book versus the previous year, just really taking into account the economic position that we're in, and that allows us to do that by being a lender and a broker. Borrower resilience, again, Ian's mentioned some of the deals that we do. We're not really exposed heavily to discretionary spend. The businesses that we're into in terms of lending are day-to-day businesses, coffee shops, resale outlets that aren't really going to go off a cliff when the economy turns bad. And also the assets that we're funding are business critical. So if someone's looking to reschedule payments with lenders or manage their creditors, if they're using one of our assets that effectively is key to them running a business, coffee machine, a JCB digger, we tend to be at the top of the queue in terms of people making sure that we get paid. Human underwriting, we're not reliant on algorithms or fancy computer systems to decide whether we should lend money to somebody or not. There is technology that we need to use more of to make us more efficient. But what we look at is deals where you need human eyes on them. So that's very much making sure that we use our experience of the people in our teams to decide whether we lend money to people, rather than just using machines to decide that. We believe that we're more than adequately provided in terms of bad debt provisions. I'll come on to that in the next slide. And fixed interest rates, important to realise that we don't have any exposure to interest rates increasing. In terms of the deals that we do are fixed interest rates, and the borrowing facilities that we've got in place are also fixed interest rates for existing business. Obviously for new business, we'll have to accommodate increased interest rates on our business, but then we can obviously put them up to our customers as well in the general realm of interest rate rises. So that's obviously an important point. Okay, so financial highlights. We believe we had a very solid year last year. These are the figures up to our last financial year, which is the end of May. Deal origination, as you can see, was up 13%. That's the total new business that we do in terms of volume, either on our own book or brokered out. Our revenue was up by 6%, just to under 32 million. Profit before tax and exceptionals was up also, as you can see there, just over 8 million. Our net assets also increased by 13%. Earnings per share were up slightly by 2%. The average cost of our borrowing went down, which is a good point. We've made a concerted effort to try and reduce the cost of our wholesale facilities that we borrow in order to lend out, so the net interest margin increases. That's a key part of our strategy, which we'll come on to in a moment. Our funding facilities increased slightly. Again, that's a key part of what we're looking to do in the future in terms of generating further capacity to lend out. And our bad debt provision increased slightly, where we're now just under 2% of net portfolio. And again, there's a slide that gives a little bit more detail on the provisions in a moment. So all in all, a good solid set of results. Our own book, this is where look at the provisioning and where we are at the moment. So our own book in terms of the money that we lend out ourselves, not the origination that we broker out, totals 142 million. You can see there that, as I mentioned, it was slightly lower than the year before. That's because we chose to broker out a little bit more business last year. The bad debt provision in 2.4 million down here, which is just under 2% of the net receivables. And you can see there the difference in terms of where we sit with the different products. So asset finance is probably the more risky of the business. The invoice finance is very low provisioned. We tend to be secured by, firstly, the book debts, the invoices, as long as they're bona fide, you collect them in. The secondary security is an asset debenture, so you have first charge on the other assets of a business, and then you have a personal guarantee as well. That's why the provisions are very low in that business. And the loans sort of sit somewhere in between. But again, the loans are secured primarily by a debenture, a second charge on somebody's property, and or personal guarantees. So all in all, we had write-offs of 1.3 million last year. But as Ian made reference to, we've got data that goes back 10 years or so that shows that we are very good at getting back money that historically might have been labelled as a provision. So we actually recovered 700,000, which meant that the net charge to the P&L last year was 600,000. So in the market that we operate in, outside of what we would class as tier one or top of tier two lending, we're really bottom of tier two, top of tier three. We believe that's a pretty good performance. And in our funding side as well, I mentioned before, one of our key points is to make sure that we've got increased funding capacity so we can lend out more money. That's really to support our next 5-year plan, which I'll come on to. You can see there how we're funded. So the asset finance business is funded by a series of wholesale block funding facilities through these people down here, mainly challenger banks and wholesale funders. And we've got around 10 business partners that we work with on that funding side. The loans business is secured by a secured loan note program, relatively modest at the moment. We're £10 million a facility. And the invoice finance is supported by a back-to-back arrangement with RBS to the tune of 37 million. They're the key player in that market. They've got appetite to go further. We've had discussions around that. When we need to, we can increase that. And we'd envisage that will creep up to over 50 million over the next couple of years. So all in all, we're adequately funded and we've got solid relationships that we believe we can increase funding lines to accommodate and support our next 5-year plan. Our gearing remains fairly consistent, 3.4 times net assets. The average cost of borrowing, as I've mentioned before, 3.9. We're looking to reduce that further. And there are potential opportunities to get additional funding into the business that provide us with hopefully some flexibility to do some further growth and some smaller acquisitions. So I suppose that really sort of concludes the first part of the presentation, which is who we are, what we're doing, our numbers. And the next part is really what we're looking to do in the future, hopefully, which is probably a bit more interesting in terms of achieving better and bigger business. Our plan really is to more than double the business over the next 5 years, as you can see. You'll recall the first slide that Ian took you to over the last 5 years. We believe we can do that through organic growth in terms of how the business is now set up and the markets that we're targeting and the people that we've got in the business, but also combined with some further acquisition opportunity, but mainly bolt-on opportunities through the existing divisions that we've got rather than anything revolutionary. So you can see there we're looking to take the business nationwide through the UK. That is not putting expensive offices in place. There are 2 or 3 key centres where we need to get more on the ground capacity, so there will be 1 or 2 more offices opened, but that's really having sales and relationship managers more spread across the country than we have at the moment. So trying to manage the efficiencies and the cost base as well. We envisage going up to somewhere near 300 staff, and our loan book more than doubling to 350 million, which will generate around 90 million of revenue. So an exciting story ahead, and we'll see in a minute in terms of the team that's been set up to deliver that is obviously key to achieving this. How will we achieve that? Well, very much through people. I'll come on to that. But there's a series of strategies that we're looking to deliver that are set out there. I've mentioned some of them already. Building through organic growth, but also some carefully selected bolt-on acquisitions. Reducing the cost of our borrowing, which we believe we can do further, and finding other facilities. Increasing our own book. So at the moment, there are businesses that we decide to broke out for various reasons that we could potentially put on our own book to support a growth strategy. That may mean a little bit of compromise in terms of margin, but it should provide a little bit better quality coming onto the book. So we have to manage that carefully. But we've done some analysis. We do believe there's further capacity that we could build up on our own book rather than brokering out. And it's really getting that balance right between the initial hit you get from brokerage income, which all comes up front, versus building a long-term plan where the own book income drips into the P&L over 3, 4, 5 years, however long you decide to lend it out. We're looking to rebrand, which is one of our exciting projects that we're right in the middle of at the moment. I can't tell you what that will be to, but it will be bringing all the individual brands together that we've acquired and launching something new and fresh and easier to position ourselves in the wider market rather than having the sub-brands that have come through acquisitions where the businesses have been around for 10, 12, 13 years that means something different in their own market versus what 1PM is trying to do as a group. So that's a really important part of our strategy and something that will hopefully be live in the early part of the new year. We're also looking at introducing some new products and new territories, potentially outside of the UK, not into any weird and wonderful parts of the world, but there are opportunities in Western Europe, particularly in Ireland, places like France, Germany. There's mature financial services markets at the small end of the SME lending spectrum that we believe we could take advantage of. And there's experience in our team for people that have done that before, and that's an option for us in the future. We are looking to innovate through using further use of technology and digitalise our business. It's something that I'm sure everyone will be aware of in the financial services world over the last few years. Fintech is an overused phrase for me in the sense of what it actually means. Our first stage of this is really making the business more efficient through the use of IT. The second stage is trying to develop some fintech capability to basically make it easier for consumers and businesses to do business with us. So at the moment it is quite manual. Brokers introducing business to us, suppliers introducing business to us. We speak to them, we make a decision, and then we go through a process of whether to lend or not. We do need to get a little bit more tech savvy in terms of all of us going online and being able to get at least an indication of a decision and of a price, because that's the market we're operating in. And that's a project that, again, is live and we're looking to move forward as part of our 5-year plan. We're going to continue to invest in new people and develop the people that we've got. A really important point, we've put together a team of people that have come from a variety of backgrounds. We need to make sure that they're trained and invested in and not just left to it. It's a key part of businesses that forget about their people, assume that they've got all the skills to deliver this great 5-year plan, and then when it doesn't work, we all look back and say, well, the people weren't suitably skilled. So through our HR team and through making sure that we might make that right level of investment, we're going to invest in the training and the succession as well to make sure that some of the people that have come with some of the acquisitions who may not be around in the next 5 years are suitably replaced, and that's already being done. And cross-selling, that is a key part. We've already started that. We've had some good success without really putting a lot of investment around it. It's really been done through introducing people to each other in different parts of the business, having an annual conference, explaining what we do, putting incentives in place for people to benefit from cross-selling. We're probably 30% of the way forward in terms of what we can achieve from that. I think there's an awful lot more we can do. The rebranding will help by having all products and all businesses under one name. And there's an awful lot more that we could do to go and sell invoice finance customers with vehicles. I mean, all of our invoice finance clients need vehicle finance. And we haven't really made a concerted effort at targeting them. It's really been on a reactionary basis. So that is a key strand of our sales strategy for the next 5 years, the cross-selling plan. Just to spend a few minutes on the management team, because obviously this plan won't happen without the people delivering what they need to deliver, and I think it's worth just understanding who they are, because we have spent a lot of time in the last 12 months putting this team together. Personally, I joined the business through meeting Ian through a mutual business contact, one of our solicitors, and I joined 2.5 years ago. So the executive team, Ian, myself as COO, James Roberts as CFO. James has done some roadshows with Ian. Some of you may have met James. He joined with roughly the same time as I did, so we've been in the business at the same time. Trained through PwC and worked in industry since then. Jem Bodie spent 17 years at the FSA in compliance. We are a regulated business. Not all of our business is regulated, but compliance is really important. Hence, we're delighted that Jen came on board, and she's been on board now for 18 months. So that's our executive team. Our board is then supplemented by 3 non-exec directors. John Newman as chairman, Ron Russell, who Ian mentioned before, is the non-exec director and the Rangers supporter. He's also a fairly significant shareholder in the business, owns about 12%, and has been involved for a number of years and has been very supportive of the business throughout that time. And Julian Tellin is the senior non-exec independent director. So that's the board. The wider management team has effectively got 5 divisional heads in terms of the different products for asset finance, invoice finance, vehicle finance, and loan finance. And then there's 4 heads of functions: IT, marketing, HR, and risk. A mix of people that have been in the business, people that have come with acquisitions, and new people that have come in. So to give you an idea, Carol Roberts, sort of an asset finance stalwart, 50 years in industry. She's provided great level of stability for us. She's got a lot of contacts. She's recruited people beneath her to set up that division, and has provided some really great input to the business. Alan Winter, he came with the Intelligent Loans acquisition in Cardiff. Mark Burgess came with the Car Finance to You acquisition. So those 2 guys have now moved on, if you like, from their own businesses that they sold to bigger divisional roles where they see a career ahead of them. It's important that we migrate those guys from thinking about running their own business to running a division in something that's bigger, and give them the right level of incentives to achieve that. And then Phil and Tansy in the invoice finance side. Phil was a founding director of Positive Cash Flow, so he came with an acquisition. Tansy was a new recruit 2 years ago from Bibby Financial Services, who are one of the leading providers in the invoice finance market. Lorraine, she spent nearly 30 years in the Lloyds banking group, in various brands, Bank of Scotland, NWS. Great range of skills on risk management. And she's been a great asset to the team. Holly came through the ranks. She was actually, I think, the 4th or 5th employee originally in Bath when it started in 2006. So nice to see someone actually coming through the ranks and becoming a senior member of the operating board on head of HR. Diane, 25 years in marketing within invoice finance. She worked with me at Bibby Financial Services for 17 years, so I know her very well, very capable. She's leading the rebrand project at the moment. And Dave Jones, our recent recruit, a couple of months in the business to beef up the IT side of things. We needed someone with more experience, and he will be very much involved in taking the digital side forward. So I think from that you can see that there's a broad range of facilities. There's a lot of experience. There's much more experience in the business now than there was when we just bolted on the acquisitions and then found out we had 7 businesses and 190 staff. We've got a good senior team, and I'm excited about the team in terms of what they can do delivering this 5-year plan. Just a word on competition before I wrap up. You can probably gather in terms of where we sit in the market now. We're not a bank. Really, there's sort of two ends to the spectrum. There's the banks, which we would now include as the challenger banks, Aldermore, Metro, Shawbrook. These guys are well-known businesses now. They tend to operate more akin to the high street banks in that they've got lots of strengths, lots of well-known brands, lots of digital capability, and they definitely have the range of products. What they don't tend to have is the flexibility, the speed of service, and the personal approach. That tends to be focused at the other end, which is the independent companies, whether they're quoted or privately owned. They're very much set up, as we are, around the customer to be flexible, to be quick. You have to be quick when you're operating against bigger competitors. We definitely compete against those guys in the market, but we believe there's very few that have actually got all of these things at the smaller end of the market. So having the range of products, the personal approach, the speed and the flexibility, we believe we've got all those. At the slightly higher end of the market, sure, there's lenders that will say the same things as well. But at the sort of start-up to 5 million turnover size business that we're really targeting, there's very few people in the market that have got our market position. So again, a great opportunity to develop the business further. And really, in summary, that's the first point, really. We've got an ideal market position, we believe, to further take this business forward and achieve further growth. Our results were good, and they're in line with expectations, as they are for this year. It's a steady, sustainable performance that we're looking to put in, and that is attractive to some people, but it's not a revolutionary triple the size of the business in 1 year. This is steady earnings and sensible growth. Sticking to the core competencies and strength that we know we can be successful in, not deviating away too much from sensible business lending with the right level of security and the right rates for the job. Progressive dividend policy has now been agreed and put in place 12 months ago.
We're in the second year now, yeah.
Second year of that, and it's been set out in terms of how we're looking for that to continue to progress. And as you can tell, we've got ambitions to make the business further successful, organically through the team of people you've seen and the strategies that have been set out, and also strategically by taking advantage of opportunities that we believe are out there. It's a very fragmented market in all our markets: asset, invoice, vehicle and loans, and there are opportunities out there for us to further grow the business through selected acquisitions as well. And that's it. Thank you for listening, and hopefully we've come in on time. Any immediate questions?
Can you give a bit more rationale to your rebranding exercise?
Yeah, we've got a number of businesses that have been around for a long time, and we bought them with one of the rationales for buying these businesses was they fitted a certain mould in terms of the culture, their market position, their risk, their management teams. So it's not like they were completely alien to what we do. But they've also got their own little silos in the sense in terms of what they're known for and what they do. And as the management teams have migrated away from those businesses in terms of earn-outs coming to an end, we've got an opportunity to position them in a little bit of a different area to what they were. And when we speak to introducers who deal with across the spectrum of what we do, you still find lots of people that actually don't know that 1PM owns Generate or owns Positive or owns Intelligent Loans. And the opportunities there are being lost because they don't know that. They don't associate one side of the business with another. So by bringing it all under one, we believe we can increase business. We can get a business that's more easily understood in terms of what we're looking to deliver, and we can cross-sell more easily. Because if we go to a customer, one of our customers now, and we're trying to promote another brand, it becomes a bit confusing. They don't necessarily make that association. If we're promoting the same brand, How we're organised behind the scenes, whether one person's in Cardiff or one person's in Manchester, if we can get that right, it doesn't really matter. They just need to see it being one business. So as well as making it nice and organised, as well as giving us an opportunity to relaunch the business and create some marketing and PR out of it, the fundamental reason is we believe we can actually increase sales from it, and that's the rationale behind it.
Thank you.
I've been a 1PM shareholder for a while, and I'm very conscious that while you would like to do some strategic acquisitions if the right thing came along, clearly our own paper's only rated at about 4.5 times earnings at the moment. So how would we be able to make an acquisition? How would we finance it?
Well, it's a challenge because of that issue. It's probably more challenging now than it's been really, certainly since I've been involved in the business. There are some deals, one or two of which we've got live discussions on in terms of trying to put the majority of consideration against future earnings. So getting people in the business, giving them the security of what they can achieve, and then obviously the reward is more back-ended. Being honest, those deals aren't that attractive for people looking to sell their businesses, and they're few and far between. So the other side is really getting other wholesale lending facilities into the business where we can use those for acquisitions effectively. And that's really taking advantage of the various debt facilities that you can tap into now. And again, we've got ongoing decisions there. So that would be the two main strands of where we can effectively get some deals done until we're at a point where we're in a different cycle in terms of the share price, and we can go and raise money, hopefully from existing shareholders.
Sorry, then a quick follow-on question then. Are the businesses that we look at on similarly potentially lowly ratings like we are ourselves just because of the nature of the market at the moment?
Not necessarily, no. I mean, virtually all the businesses that we would look at are privately owned. So it very much depends on where those owners are at in terms of the cycle of their businesses. And again, the most obvious one is where people are looking for retirement sales. And that way you've probably got a bit more leverage than someone who doesn't necessarily need to sell their business. So, that's, again, where we focus our efforts.
So one of the things you said in the past is that you can scale the business without adding significant costs and therefore get sort of operational gearing. However, sort of in the last couple of years, and the guidance for the future is that you have to actually invest in people, invest in the business, sort of what's changed, and when are we going to see the benefit of that? When's the operational gearing actually going to kick in?
Sure, and that's, I think, really good question, because it's probably the biggest day-to-day challenge that we've got on at the moment in terms of recognising that the team that I outlined cost money, training costs money, the investment in people costs money, just scaling up the business costs money. There's probably two things there. I think the discussions that I've heard and had with Ian and James and understand the message that are put out to shareholders in the past are still very relevant. But I think there's probably more understanding now of just what investment is needed to make the business achieve what it needs to. So I'm not saying that the messages that have been put out in the past are wrong, but I think there's probably, you can see there's more people that are having their say now in terms of what we need to do. And there's probably more understanding of what it will take to achieve the things that we need to achieve in terms of cost. So that's the first part of it. The second part of it is really having defined projects and milestones and reporting around these things. Whereas before, I think we would go ahead with some things and we wouldn't necessarily understand just what the savings would be and what the investment would need to be to get to where we need to. And we're getting better at getting project management put in place, teams put in place. Those people have got better skills, I suppose, than what we had before. And we've got better reporting now, better MI, and we've got better understanding of what it is we're trying to achieve. So there's two things to your answer, really. One is that there's probably been a more realistic view of what the cost is to achieve what we need to get to. And the second point is that we need more visibility and more challenge and more reporting around how we're going to get to those things. So it's proper project management, really.
And potential timing for operational gearing to kick in?
Can I just pick up on that one? I mean, I think on the chart that you showed there of 2024, in terms of the numbers that we're proposing to get to by then, that's the £350 million book, and I think it was 300 employees and 90 million in revenue. So really, it's over that time frame that we can see the increase in the book and the increase in the level of revenue without a proportionate increase in the number of people. So there will be operational gearing coming in gradually over that period.
Thanks very much indeed.